Benton.
Witten! Happy Friday, my friend.
Happy Friday to you. Happy Friday, folks, dialing in. Mate, it's been too long between drinks.
Quite literally, hasn't it? Feels like we haven't done this for a great many days. Weeks.
Yes, weeks, maybe even a month or so. But mate, awesome to be hanging out with you today. Looking forward to hanging out and chewing the fat. We've already got a few of our regulars on board. Welcome back. Thanks, Alison. Hope you've got a glass of vino or a little something there for this afternoon, and we'll see how we roll. Mate, what's going on? We haven't done this for over a number of weeks, folks, and there's been a lot going on. I reckon we'll probably talk the leg off an iron chair this evening. We shall see.
Well, I'm curious to know what everyone's thinking out there. So, are there any hot topics, any things that you're noticing out in the media at the moment that are pushing a few buttons, or what's on your mind? Put us a couple of thoughts in the chat for us, and we'll get things going. I got 50 slides I could go through here, Jace, but interested to know what it's thinking out there at the moment.
Plenty going on. Well, for anyone who's joining us and they haven't been here before, you might be wondering by and go, what's this live show happening or what's going on? Well, Andy and I created this get-together, little live stream get-together over 2 years ago when COVID descended upon the world and all of our businesses and all of our investing. And we thought we would get together and debrief the week each week when it came to the world of investing. Andy in the world of banking and business and finance, and myself in the world of business and real estate. So, folks, welcome along. We have been doing this for a collective, probably collective over 50 years between us. Makes us sound old, but along the way, we've learned a few things. We've done a few good things, done a few stupid things. And we get to share some of those things with you guys as we go. But we do have a little bit of a very rough, Andy, a very rough way we like to run the show. But it's pretty loose. But we try to do something like what's in the news. We like to do things you should know, and maybe get some of your questions answered. So Alison is already talking about, hey, why shares went down, each interest rate rise, and last time they shot up. And I reckon I've got one of the answers to that one soon. But that's something we're going to talk about, Alison. So stick around, Tim. Yeah, less increase. Well, that's what I reckon, Tim. Certainly, I felt like when it came to the rate rise only being 0.25, I felt like we won the lotto from a investor and lending point of view. I think there's still 3 more of those 0.25s to come, maybe even 4, but we shall see. But Andy, few people chucking some questions in the chat already, which is great news. And the old live stream's just getting a little warmed up right now. So if you're there and you've got any questions, whack them in the chat. We might sort of kick off and get into it, mate. Why don't I lead?
Well, before we do, mate, I know we've got what's in the news, but a typical segment. What's in the glass, mate?
What's in the glass? Well, what's in the glass for me today is I can't even say it, Alicante Boucher. Alicante Boucher, very fancy, very flash. And got that from down in my trip and tour in Adelaide. So hopefully it goes down all right, mate. It goes down all right. But it is a bit of a strange one. I feel a bit weird drinking at 4:00 on a Friday because daylight savings has changed for you and the rest of Australia, but Queensland kind of stayed the same. Is that the same? Is everywhere changed other than Queensland? I don't know. Let me know in the chat.
Queensland and WA are the 2 outliers. But then
troublemakers.
Always have been. Always have been.
Yep.
But we love a good troublemaker.
We do. But that's good to see. Well, welcome along, folks. Why don't we get into the show today and see what's going on? Ding dong, the witch is dead, Andy.
Oh, what a stupid! Yeah. Anyway, we called this. We called this a little while ago. So let's phrase it up. What do you mean by ding dong, the witch is dead?
Well, unless you've been living under a rock as a property investor, the idea of Queensland being absolutely insane and trying to double tax property investors with their controversial land tax plan. They've received more heat than they could possibly imagine from such a stupid idea. I don't know who they asked in the first place. Obviously, nobody. The premier has had to come out and said, "Hang on. Okay, we're not going to do it. It is a stupid plan. Let's get rid of it." They snuck it through in the budget, Andy, with very little detail, and it was quite hilarious. It was great to see a few of the other states. The New South Wales Premier said, "Not on my watch, ladies and gents. You won't be doing this, and I won't be giving you any property owners' details from New South Wales, so you can stick that in your pipe and smoke it. Good luck with your plans." And pretty shortly after that, yeah. Not only that, Andy, there were some very smart people looking at it as an illegal tax. It was unconstitutional, wasn't it?
Well, it's not a controversial, it's an unconstitutional land tax.
Yeah.
And perhaps if some of these politicians actually went to school, I'm starting to think that it's the Ricky Gervais thing. You know, it's almost like these guys have spent less time in school than Greta Thunberg. But we coined it straight off the bat when it came out. We said it's anti-constitutional. It's creating a double tax. The reason why they found it so difficult a little while ago, Jace, these penny thieving politicians. Actually, that's great. Love it. Because
thieving, the PTPs, penny thieving pollies.
Jace, you might remember that a little while ago they tried to get the franking credits taxable, or weren't going to give the franking credits back if you're in pension mode. Now, there was a whole lot of rhetoric thrown around as to the reason why it didn't pass. But the reason why it didn't pass is because it's a double tax. And if these idiots actually understood the Constitution of Australia, which clearly they have no idea about, they're representing, largely the Constitution of Australia, but clearly they haven't read the rule book. And it's a pretty big rule book, but Jesus, one of the most fun, here's the rub, Jace. We have double taxation treaties with 40 countries. God, we've got it with Papua New Guinea. And so fundamental to the tax legislation is this idea that you can't get taxed twice, right? I've just brought it up. It's insane. And hopefully you might be able to see this.
I'll put that up there for us. All right.
So this is a website. Tax summaries from PricewaterhouseCoopers. Now, look at the list of countries that Australia has a double taxation agreement with.
Make it a bit bigger. I think you squidged it for some reason, somehow.
I'll just go around. There's a list. We've got it with Russia. And they're trying to invade the Ukraine at the moment. British Virgin Islands. Where are the Virgin Islands? It's got an asterisk there. So the reason why this is laughable, Jace, is that foundational to the tax legislation is this idea that you cannot get taxed twice.
Yeah.
Right. And we've negotiated this with countries all across the world, and some witch, ding dong, comes in and goes, you know what? I've got a great idea to pull a few pennies out of other people's pockets. We'll create a new land tax. How absolutely bloody ridiculous, stupid. It was never going to get up. Scared the living daylights out of people. And mate, if we had a shame file, do you remember Darren Hinch, the shame file?
Yes.
Shame
on you.
Unbelievable.
Well, thankfully, well, I don't know if common sense provide, because they don't have much of a way of common sense, but the law, in its in its in its
Fairly black and white
essence,
way.
yeah, in its essence, is there to stop this sort of ludicrousness happening. So we're glad to see that occurred. So big tick in the box for property investors, Andy. Certainly those who polled into Queensland, and we did have a huge amount of people thinking that they were going to pay a lot more than they should have. Now, one thing we did from that is we actually created, ladies and gents, a land tax calculator for people. So if you want the land tax calculator, you need to join my mentoring program, and I'll give it to you. And if you're in the mentoring program, you can get it for free. But let's talk about something else. And Alison asked about why is it that shares went up, Andy? Because it was only a 0.25 of an increase of recent times, or the last rate increase. But check it out. This has been pretty nice for a period of time. Actually, I'll make that a bit of a different color. It's been pretty nice for a long time. Low to no interest out there in the marketplace, and we have had a number of consecutive increases in rates of recent times. Andy and I were talking one of the last Wealth, Wine and Wisdoms that we did about the bond rates, the 1 and 3 and 5 and 10 year bond rates, which correlated to this stuff, which is interesting. And Andy, I remember you and I, and I'm absolutely sure it was on one of the Wealth, Wine and Wisdoms. I was trying to find it the other day. You and I talked about, hey, we think it's not going to be another 0.5% forever and a day. I reckon they'll slow down before the end of the year. I wouldn't be surprised if it wasn't a 2.5. And lo and behold, abracadabra, here we are, slowing the rate down. And again, it made sense because Andy was talking about when we look at long-term bond rates or medium to long-term bond rates, it's an aggregated financial emotionless opinion about where they think cash rates will land, not media and banks and all sorts of unfiltered opinions. The price
Unfounded,
of the bond,
unfiltered, and sometimes
unfounded,
ludicrous.
uneducated. The bond rates are actually like a really good way to aggregate this thing. So, but anyway, what's the point? The point is, team, a slowing down of that, I believe, is going to give us a nice little soft landing sometime around the end of the year or maybe early next year, where that will be zero or no rate rises into the future. And at some point by the end of next year, I reckon they will reduce it. That's my call. I'm putting that here right now on Wealth, Wine and Wisdom. But Andy,
I'm going to go. They'll overshoot.
Yeah,
I reckon they might overshoot for. Yeah, I reckon they might overshoot it, and then they'll wind it back. That's what history tells us that they do, and they do it in about a 3 to 4 month block. They really create some pain or some stupidity, and then they realize they've gone a little bit too far. People start, it's almost like that confirmation bias.
Yes.
You start to make decisions, and then all of a sudden it's like, oh, it's now easy to raise rates, like we've been doing. Oh, we'll just keep going. I'm hooked on the drug, Jason, and my parents are pensioners, and they're enjoying the 6% savings rate. So my tip would be, and it's really just based on historical evidence of them making or overshooting and having to correct back. And it's part of the reason for that as well is, and I'm not taking a pop at the Reserve Bank. I think the politicians have taken enough of the pop of the Reserve Bank, trying to blame the Reserve Bank for the screw-ups that the politicians have made. It's unbelievable. It's like a schoolyard. But the inflationary data that the banks, the Reserve Bank uses to raise and cut rates, it's 3 months old at the time that they make the decisions.
Yeah.
So it kind of makes sense, right, that they're going to overshoot that measure based on how the statistics roll in.
Yeah, in history, and that's an interesting one because, I say this all the time with property investors. With a valuer is looking 3 to 6 months in history as well. It's very rare that they would take a sale today as gospel, that they would hang their license or their hat on. For us as investors, to look into the moment now and or into the future, we need to understand how to do that. When it comes to interest rates, when it comes to values, when it comes to all sorts of things. So yeah,
So
that
to,
makes sense.
to answer Alison's question, Jace. So you've kind of jumped around it and you've alluded to it, but let me
Well,
ask you the question directly.
I was going to throw to you in a second. All right.
Oh, okay. Well, I'll shut up. Keep going, Jace.
Well, let me finish this section, Fenton, and then over to you, my friend. But this is one little lesson, folks. And Andy, we all had quite the time of it in here when it came to these low interest rate times, and for those who could, was a great time to purchase real estate. Like it was pretty inexpensive, low risk, etc. Now, our borrowing power, we call that the BP and servicing, the ability for you to get access to some borrowing was actually, as easy as it was going to be when it came to the expense of your interest. What now, when interest rates have gone up or cash rates have gone up, interest rates are passed on through. What's been the impact to borrowers, Andy, for their ability to borrow now into the future? What does that look like when it comes to, getting access to capital, getting access to cash? Well, there's been a pretty significant adjustment in people's ability to borrow. If you have a look at this quick little chart here, literally 6 months ago, someone could borrow 500,000, and now their ability to borrow is 391. Right now, this is approximate, and if you were sort of sitting around 6 months ago, if you were sitting around 2 years ago, waiting for the property market to collapse, this is the cost of that uncertainty or not taking action. Now, the ability for you to buy a certain type of property, or now the ability for you to borrow has been reduced pretty significantly. So, on average, about 20% so far from 6 to 9 months ago on lending. And it doesn't mean, folks, this is the thing, Andy, it doesn't mean you can't afford it in your cash flow, right? A lot of people have heaps of spare cash flow. I see this all the time when we look at borrowers or people who want to buy. What is happening is about 18 months ago, 2 years ago, they put an extra percent on top of the risk, the loading rate for finance. So it went from 2% to 3%. And now interest rates have gone up. So I called this yesterday as well, Andy. I think by the end of the year, maybe early next year, the banks will remove the risk on top of risk rate from 3%. They'll reduce it back to 2%. I'm calling that. It doesn't make any sense that you move into, like, you have a double whammy on borrowing on borrowers. Interest rates have gone up and risk rates have gone up. That'll change. The rents will go up, especially for investors. Especially for investors, the rents will go up a little bit and offset, some of these borrowing restrictions. So a little bit of an impact for people. But mate, I thought it's great news. Ding dong, the witch is dead. The Queensland tax is over, and we actually, are slowing in cash rate rises. But over to you for answering Alison's question. Really, at the end of the day, that's what Why did they react in a positive way, Andy?
Well, what does everyone think? I'd be interested to know what everyone out there thinks.
Well, we had here from Tim. Tim said consumer confidence. People felt better about the world because it was getting worse slower. Is that a simple as that? So what does anyone else think? Yeah.
It's probably not too far away from that. So markets are always pricing in the future. That's pretty much what happens in markets. So markets aren't priced for today; they're priced for several years in many cases down the track. So the way that we look at pricing equities, which are shares or stocks, whatever you want to call them, we have three different names for the same thing. just to make it more difficult for everyone to understand it, I think. And so effectively what they do is they it's like a discounted cash flow model in some cases, but they're going, what's this company going to be worth based on its cash flow and its growth prospects, several years down the track.
Yeah.
And one of the major inputs to it is interest rate, because interest rates are expenses. Company borrow them. It's the way that they raise capital as well. So it dictates a lot of what happens in listed companies. So at any point in time when a market is shocked by an event that it was expecting to go in a different direction, the market will move to arbitrage that gap in expectation. And this goes to, you and I got to catch up with Mo Gravatt. I might have butchered that, who was one of the most successful leaders in Google. Wonderful, wonderful man. And he has a happiness equation, which I love. Let's see if I butcher this one. It was
give it a whirl.
Happiness equals life events being equal to or greater than expectations. Happiness equals life events being equal to or greater than expectations. So markets are very, very similar. If a market is happy, is when the expectation of what's happening in the world or the events that happen in the world are less abrasive for it. So what I mean by that is if the market thought that it was going to be a 0.5% interest rate hike, then it priced in a 0.5%. As a matter of fact, the market's priced in basically interest rates to be going to 4% in the cash rate over the next 3.5 to 4 years, right? And we're likely going to hit that sooner rather than later. Right. So that's what markets are priced in. So when the market does what it did, and we had and let's, mate, 50%, it was 50% under the expectation, if you want to sensationalize the headline. But it was ultimately 50% less impact on the market than what was expected. And as a result, the market very, very quickly figures out its reference point and it goes back. It really doesn't have much to do with consumer confidence, because consumers don't react that quickly. Like you and I didn't go, 25 basis points. Yep, let's buy some stocks because now I'm a little bit happier. But it's a really astute observation. And I think that I saw also a couple of media channels saying that market confidence is up. And I'm like, oh, for God's sake, people, like, really? What? I mean, how like all of you who are listening here, how many of you all went, oh, wow, it's only 25 basis points. Better put some money in the market. Like it just, headlines can be so misleading, and I think that I think I saw it on the project. They got it wrong as well.
Yeah,
allegedly might have gotten it wrong. So that's why markets went up when interest rates went up.
Well, there you go, Alison. Hopefully that. Yep. Well, mate, what do you got on the agenda, mate? I've got a couple of things later on that I might share, but what have you got on your
mate, in the news? So this one, I love this. This is one of my favorites. The big banks are losing deposits to more generous second-tier rivals as savers shop around at the over 4% mark, which is magnificent. One of the benefits of increasing interest rates is that you've got areas that you can store your money and actually make a little bit more than what you were yesterday.
Yeah.
And so one of my big coins, mate, is I reckon the banks are going to start competing against themselves very, 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 very soon. Because I know that a lot of people are looking at second-tier lending now for the same reasons that you're articulating earlier on, a little bit more lenient, a little bit more competitive. And they're also offering, substantially higher rates. So my tip is that the big banks will start to move on this reasonably quickly and reasonably soon as well. The reason why I say that is I think that savers, people are more hypersensitive to rates at the moment than they've probably ever been. And as a result, and the other thing is, mate, 2% to 4%, that's 100%. So you think about the headlines of what's going to be rolling out from the second-tier lenders. You can get 100% better return on your investments. And then that'll turn into, I've got 100% on my investments. Not true. Yeah. Get ready for the big pricing war between the banks and their second-tier cousins.
Well, I mean, yeah, if you think about that too, Andy, it's it used to be easy to talk to, clients and customers and say, hey, listen, if you got spare cash laying around, put it in your offset account because your interest rate is 7%. Like that's money. There's money saved as money earned, and you don't pay any tax on it, etc. You know what I mean? But the last few years, it was like, hey, money, cash is trash. Put it to use somewhere.
Cash is trash. And is it Brendan? Brendan. I thought it was Brandon for a moment. I thought we had our old heckler friend back on the YouTube
our good
channel.
mate Brandon back. Hopefully, yeah. No, this is Brendan.
Look around, Brendan, because literally just had a client of mine knocked back by the big four, and then was offered 900. Listen to this, 900 cash out by another one in the market. It might have been Bank West or it might have been Bank of Queensland or one of these. So, mate, shop around because a good broker should be able to help you out. And maybe you're already in that space. I don't know, but a little bit of a tip. Now is a great time to be shopping around when it comes to mortgages and when it comes to fixed deposits and things like that, because you'll get some ripper deals and the banks are going to start to get competitive. And what Jason was saying, the reason why they want to scrap that 3% to 2% is so they can lend you more money. Banks don't have wealth management in there. They were dragged through the coals on in the Royal Banking Inquiry for charging dead people and doing all sorts of outrageous conduct. And so they left. So that tells you something about the banks, doesn't it? When the Royal Commission came out and they said, well, you can't do that anymore, they've gone, oh, well, we won't do any of it anymore then.
We'll get out then. Yeah,
if we can't operate like that, we're out. But the reality is now that banks really are more reliant on loans. So for the banks, cash is trash as well. They want to be lending more money so that they can make more money. So stay tuned for some great deals out there. It still makes it. I find it very, very difficult to say Prime Minister Albanese. Well, just it doesn't sit well for me. Unfortunately, not all the witches are dead, mate. But certainly one thing that is dead in politics is truth. And so an election promise about not touching.
I don't think it was ever alive, Andy. I don't think it was ever alive.
Mate. I thought that at some point in time it might have had the most, the tiniest little labour of a heartbeat, but unfortunately not. So we saw this coming a mile away. Have a look at that face. That's a face no one would trust, apart from the majority of the population, apparently, because she's our Prime Minister. So straight away, I love the headline, though, because it's actually quite accurate. Prime Minister Albanese has, God, it's like a frog in my throat, has all but given the green light to paring back the stage 3 tax cuts by supporting claims by his treasurer that the budget faces unexpected structural costs. I love that, Jace. Unexpected structural costs. That's almost quoted directly from them. It's kind of like you and I raising our prices to everyone around that, and it's like, why were you raising price? Oh, we had some unexpected costs. Are you happy with that explanation, Jace? Good. All right, let's move on.
Beautiful.
I reckon there'll be some political argy-bargy around this, but probably not for very long. But what was looking at a really, really good, solid tax plan for the future now been repealed. So the witch is dead, but Albanese is well and truly alive, and he is finding pennies to pinch from our pockets. Also thought this one was a little bit interesting. With mortgage rates expected to hit 5.5%, right? Homeowners need to decide whether to pay down their mortgages, tip money into super, or invest outside super. Wow, what a headline, Jace. Let's just move on past that one. How to say nothing within a headline. Yeah. Well, they're either going to do this or they're going to do that. Happy days. I think you and I have an opportunity to be great journalists. But, mate, the wine fund, right? We've been talking about the wine fund due to release next year.
Watch this space, folks.
Watch this space. I've just made that public now, so I really need to get a wriggle on, don't I?
You need to get on with it now, Fenton.
But I love this. A bottle of Penfolds liquid gold. Now, who knows what Penfolds liquid gold is? I'm interested to know. But a bottle of Penfolds liquid gold fetches $150,000 as crypto set to crash. I don't fully get the crypto crashing side of the equation, but Langdon's had its first live auction since 1990s. I think the early 1990s. So the exclusive affair had well over $740,000 worth of wine sold, including this one bottle of Penfolds Grange Hermitage for $150,000. It was a bin one Shiraz of 1951.
Wow.
1951. So not a bad return by all measures. And Jace, as you know, I'm a big fan. I've been watching non-correlated markets and we invest in those for our clients. And this is one that, mate, it's another feather in the cap where I go, let's keep drinking, Jace, and let's see if we can acquire some more of these.
It's got to be tax deductible research, and that's what I like,
mate. 100%. We're all about removing risk, accelerating wealth, and minimizing tax.
That's right. That's right. Well, one thing I do remember understanding from a while ago, and I can't remember where I saw this article, but when there are tougher financial times, wine, alcohol, beer, wine, BWS, the Thirsty Camel, those shares always increase because those places get more patronage. So there you go, Andy. You've got to have it on both sides of the fence.
Absolutely. It's a great hedge, right? Even with COVID. When COVID hit, Jesus, Dan Murphy's was one of the busiest places in the world.
Totally.
Unbelievable. But possibly, Jace, the biggest news, and this is one of the biggest headlines I've ever seen.
That's a big claim, Andy.
Mate, what's in the news is the exit plan.
The exit plan
had its debut and its first live event. And from all reports, Jason, I hear that the exit plan was one of the best events put on in financial services this century. I don't know. I read it somewhere. It might have been after I scribbled it down on a bit of paper, but
I read it on my notepad.
I read it on my notepad. As valid as any headline that I've read this week, Jason.
Recently, exactly.
But, mate, it was a pleasure launching that with you. I had the crowd went wild. Yes. It was a pleasure launching that with you, Debs, and the team. So, mate, looking forward to perhaps sharing some more stories on wine and wisdom with what we find from the exit plan over time, mate. And maybe we've got something very special coming soon.
Yeah, totally, mate. Folks, if you don't know what the exit plan is, it's Andy and myself running, along with Deb here. Deb Jensen, running a business owners program when it comes to getting themselves in shape to create the wealth that they need to through business. Business is a little bit weirder, a little bit more moving parts than the world of PAYG or a career investor. So there's a few more bits to knock into shape, and we launched our first version of that a few weeks ago. It's gone well. I think we've got 3 spots. Tell me, Deb. I think we've got 3 spots left to fill out of 30 for there's 3 people who can't make the dates in February, unfortunately. So if you're interested, folks, in finding out what that might be, then leave us a little comment in the chat and we'll connect with you. 3 spots left. That's it. So we can only do 30 spots. There's 27 spots. Let us know if you're up for it. But listen, Andy, back to my neck of the woods when it comes to the world of property and property investing. What's happening in the marketplace? Well, the interest rates have gone up a little, and the taxes are still playing funny buggers out there at the front end. But I can tell you right now, we have got, and I called this a while ago, Andy. You were around when I said this. We are in the middle of a disaster, folks. And I think I said it about 50 times.
I saw the headline too, Jay. I thought I snapped it on the phone. It literally, it was, I think it was in the Financial Review. It finally coined. I couldn't get a hold of you. I rang as soon as it happened.
Oh,
But
hang on, someone's calling.
yep. No screenshotting the number. It's a telemarketer. And it literally said, Jace, it literally said, potentially facing the worst property shortage we've ever seen. That was the headline. And I thought,
Yeah.
oh, they've got a headline right. They were late to the party, but they got it right. So, mates, that they're cottoning on. I think, God, like we almost since the beginning of Wealth, Wine and Wisdom, you've been saying that we're heading towards a shortage. So that's 3 years ago now.
Mate, and it was as clear as day back then. I could tell you, like it started, this disaster we're in the middle of when it comes to the property world. Started in 2018 with the APRA credit squeeze. And it really just put a bomb in our supply chain around the country, and it's just knocked it for six. And really, it hasn't recovered. And COVID just completely, dwindled it even further.
But it's also a release as well, isn't it, Jace? And I was chatting with another learned friend of mine over the week. Not as learned as you, my friend, but pretty close. And basically saying that the release of land hasn't been up there. So even if we wanted to develop everything that had been released, that the land release wasn't sufficient in itself to keep up with demand. And this is where governments really need to be held to account, because this is a shire, local, state, and actually because it's happening all around Australia, it's everywhere. A federal problem. And this is fairly and squarely at our council, shire, and state governments' responsibilities. Because, Jace, you're a genius. I love you to bits. But the math isn't something that you need to be Markowitz to figure out, is it?
No,
it's
not.
What's the population growing by? How many dwellings do we need for that population? And as long as you're somewhere in, maybe 10,000 of that or something, you're going to be somewhere in the right mix. And mate, they just A plus B equals terror when it comes to the land, land releases.
Yeah, well, a land is much more difficult to supply as well. So, land takes more time. You need more infrastructure. You need more lead time to supply land. Townhouses and apartments, you can supply a little bit faster, but you need the flow of funding, right? So, there's this kind of balancing act. And, what happened, the first home buyer and the builder boost and all that sort of stuff around the country absorbed every piece of land. Andy, it absorbed the futures land as well. So, because unregistered land was sold to people. It doesn't even exist yet, and it was sold. So, we have to wait another 12 months for it to flow through. It's 3 years worth of absorption in 1 year, or 18 months. So, that really, and then some, and then some, and then some. But, if you look at these vacancy rates here, folks, Andy, like, look at this, out of, the 7, I mean, have a look at, the national vacancy rate across the whole country is under 1%, right? That is ludicrous. And then, some places
would say that similar, Jace, to unemployment number. I've forgotten the term that it's called, but once you get to a certain number and unemployment, I forgot.
Is it full employment or something, or full absorption or something, or whatever?
Well, it basically, because if we take a transition mechanism, and in housing, it's somebody leaving one house to go to another house, somebody moving into states, the natural flow of, social dynamics means that, I would venture to say, and be interesting to ask Sammy Saggers about this, what is the zero? What is zero? Because zero is not zero. You are at zero well before you get to zero. And what I mean by that is that people moving from one place to another, that will always have some vacancy associated with it. So my tip would be, if you're at 0.7% or around about there, that is literally, it's no vacancy.
And And that's completely, absolutely accurate, Andy. And in some suburbs, we know suburbs now in Melbourne where there is zero things to rent. Nobody's moving because they don't want to leave. There's nothing new in the suburb. There's zero turnover, and it is zero. It's like no one's leaving. Nothing's available. It's at zero, and at certain suburbs, like that's where we're at. There's no new supply. There's no one leaving because like everyone's like, nah, man, if I leave here, where do I go? It's a disaster, right?
And this is a great conversation, Jace, because I'm getting asked it a lot now by people who have we missed out on the property side of things, and and then you kind of go, well, you probably should because interest rates are going up, but people need to leave somewhere, so people will pay more for it. And then you've got a cap on banking right now. Is there a potential that if we were to say, okay, well let's just say that Jace is right, because you've pretty much been right with almost every call that you've made on this, legitimately, and the banks relax their lending, right? Because ultimately, like, let's logically think through it, right? And I learned all of this from you, but in order for developers to have the confidence to put their money and develop land, they need to achieve the finance. So they need lending restrictions to be released a little bit so that more money can go into their pockets, less risk of them potentially going down as a result of building. So they need it to go down in order to be able to build the property. Now, if we don't solve
to be more accurate with that, Andy, there's enough money for developers, but there's not enough money for pre-sales, right? So, so that's what. So, hey, listen, I'll give you the money if you can get the pre-sales. And what this lending issue has, like restricting lending and also interest rates going up, people are saying, I'm not buying off the plan. I'm buying something now, and I don't even know if I can afford it in the future. Not a chance on this planet, right? So that's what's happening. The people are going, nah, mate, not me, right?
So they're not jumping into the game. So
correct. They're not getting in.
To solve this issue, then what they really need to do is unwind all of the restrictions they put on lending in the first place that really started this issue, 7 years ago.
That's exactly right. Yeah. It's like,
and then if they were smart, they just go, we know fuck all about this, because every time we seem to make a decision,
every time we get involved, we fuck it up.
we destroy it. Why don't we just let nature take its course and allow a free market to equalize itself?
The free market works, and mate, you and I know that one. I've got the answer. Is it too late, Andy? Well, here's the answer, folks.
I saw this.
Is it too late? Well, are you dead? No. Well, it's not too late. All right. So,
so logically thinking through it, you kind of go, well, there's a potential that it'll kick, because in my world, Jace, when it comes to commercial property, there's a number of factors, but borrowing is a big factor, right? If you can't, if borrowing isn't there, then prices will not continue to rise, right? Now, there's a few examples where that's not true, but by and large, all other things being equal, can't borrow the money, or the leverage is capped, so is the price of property. Now, it seems to be true on that side, but if they then relax the servicing requirements, then all of a sudden, Joe Bloggs, who used to be at 800, who's now at 500, could then go up to 900. And then my guess would be that if that ended up happening, you'd see the houses run again.
I think you will, Andy, and maybe houses not so much as the less expensive ones. I mean, apartments and townhouses will probably get some attention sooner rather than later. And what we're going to see, and this is, it's already well underway, is that with these vacancy rates low, you'll see the rents continue to accelerate pretty significantly over the next 2 to 3 years. We've still got, like, on the radar, there is going to be 1 million people, 1 million new people come into this country. Yeah, 1 million people.
1 million.
Within the next 4 years, right? And it takes 5 years to significantly turn from where we are now to where we'd like to be, like, for production. Even
that's
if
an extra 4% on the population 4% of the now listen to this.
In
4% of the population.
already drastically lowest in 16 years vacancy rate and supply chain marketplace. Where the hell are they going to live? Where are they? What's like? Where are they going to live? Because I can
Mate.
tell you right now, the government, like the government's like shit. We need people here because we need people need to do jobs. That's all they're focused on. And then everyone's like, me and the property world are going over here. Hey, folks. Like, we need to build some things so people can, like, live somewhere,
Yeah,
Wake up, you lot,
It's whack-a-mole politics, mate. It's really whack-a-mole politics.
whack-a-mole.
Issue, bang. Issue,
Tush,
bang.
tush,
Issue,
tush.
bang.
Yeah,
Foresight and future. Hang on.
yeah.
Did somebody hear
Mate.
something?
And, Andy, this is the other thing that I think, for many of us, we need to make sure we sort of, get our heads around when it comes to, the world of, Australia. We're
Make
actually
that a little bit bigger there, mate, on the right-hand side. Let me see
well.
those
I'll
numbers.
drill into this. According to Credit Suisse, Australians are the wealthiest, people in the world, richest people in the world. Based on our net or our income and asset position. Now let me scroll in here if I can drill into this one here. So median wealth per adult, up now. That might have changed in the last sort of 6 months. Maybe we might have dropped under Belgium or something like that. But Australia's got a level of wealth and equity and savings and cash and super and all sorts of stuff that just many other countries don't have. Even though we've got some temporary headwinds when it comes to the major cost of owning real estate is your interest. But again, long term, it's still pretty inexpensive, 5%. So pretty interesting to see. Aussies are pretty well up there when it comes to the world of wealth and ownership and value. So for me, Andy, I think I don't think we'll see a major, huge, crazy kick in capital growth in the next 5 to 8 years, but I see a very quality-led growth pattern, and I certainly see a significant rental growth occurring, off the back of this next 5 years. So, yeah.
Right, 100%.
Yeah.
I've got some data that sort of supports that as well, because in an equity, from an equities perspective, if you bring up my slide there, there's so one of our favorite managers is a private equity manager, one of the world's best. So I was chatting with them more recently. Private equity is investing in businesses. Like it's the process of creating a pool or a fund and then using the money of that fund to go and invest in other businesses.
Yes.
And the idea is that if you find great businesses that if they just had another $10 million, then they could be 100 times the size, right? Or, Domino's is a classic example, right? Domino's in its app went ballistic. It was one of the top performing stocks throughout COVID. Not anymore, but was. If we have a look at this here, so what we've got here is the multiple expansion, right? So I'll try and sort of level this out. This is the MSCI World Index. So this is the growth of the world stock market, as an example, right? So in Australia, we have the All Ordinaries. If we put the whole world together, we have the MSCI World Index. So
wow.
Basically a composite of where the world is going, right? So that's the index. That's the green line up the top. Now, earnings driven. Now, this is really interesting. And this, I think, relates back into the property side of the equation. Earnings driven, which is this little, lighter shade here, right? So the factor of the growth over 20 to 22 was really only a minor part of the based on earnings driven companies. The larger part was really the multiple expansion. So these are what we call growth stocks. So think about tech stocks, Google, all of these sorts of companies. right? As opposed to Telstra, who always get the job done wrong, but they're very, very good at paying dividends to their clients, right? So what we're actually seeing here is, now that this has corrected somewhat, and we don't have the most recent figure on there now, but it's corrected a lot.
Yeah.
Right now, most of that correction has actually come from this red area here, which is the growth side of the equation. But now it's the flight to quality is a flight to great income streams.
Yes.
So if we have a look, and on the opposite side over where we can see the 9% and 10% just here, right? So this is the composite of the index. So on a global basis, information technology in 2012, right, was 10%. Now it is actually 21%. So it's almost a quarter of the globe as far as share. Almost a quarter. Getting
Wow.
up there. All right. But have a look over the last 12 months, with the MSCI world going down 21%. So that's the market return of the world over the last 12 months, or the first half, 2022, actually. So if we annualize that, it'd be more like 60. Okay. But have a look at some of these other areas like energy, right? So what do you switch on every day when you wake up?
Yeah. It's always got to be there, doesn't it?
Something that is produced. Now, energy, obviously, there's an anomalous oil kick in there, but we've also got so consumer staples have had a really, really good run. Consumer discretionary, so this is stuff that we've been buying on Amazon, slowed down significantly. Healthcare, people still need to go and get band-aids and go to hospitals. So in my world, Jace, when you say flight to quality in the real estate world, in my world, the flight to quality is the revenue streams that are being delivered and the quality of those revenue streams. And that's where the money is going these days, in my world, in the equities world.
Well, it's interesting. That's actually a direct correlation, like 30%. We have a property management business. You know that, and some of the listeners would be, aware of that as well. We've got one in Melbourne and we've got one in Brisbane. And over the last 2 years, because that is a consistent rental income stream when it comes to its value, that has risen 30%, like more, like the what someone would pay for that business has increased 30% than they would have before COVID, because they wanted a consistent income stream. I was like, wow, that's great. Even though in a tough time, someone would pay more for the business. And so I was like, yes, winning, so really interesting, Andy.
Oh, mate, it was these beautiful stocks that were paying great dividends, great multiples, were just underappreciated for such a long time through COVID, because everyone threw their money into Tesla and Apple and all of these things. But I think that we did tell people, it's like, get in early, but then, understand and learn when to get out and take a bit of profit. Because if you hold these things, especially Newton's law of relativity is to a degree true in financial markets, because in my view, financial markets it's a symbiosis, right? It's a nature reserve. And I know that I'm getting all David Attenborough on you, but that's kind of the way that I see it, is that it's an ecosystem. And like any ecosystem, you introduce foreign matter into it, and the ecosystem responds to that foreign matter. And what we've seen more recently, obviously with COVID, massive amounts of stimulus, we saw the ecosystem go to these growth stocks like your Googles and things like that. But that imbalance, that massive rapid increase, if it's not supported by the rest of the ecology or the rest of the ecosystem, then it's almost bound to come down, even if it's brought down by other parts of the industry. You're almost guaranteed to have some equalization, and that's what we've seen. And these value stocks just kept on plodding away, but nobody wanted them, Jace, when they were just giving 6 or 7%, just consistently. Nobody wanted them, because they're like, oh, well, we want the 40%. And now the market's off 30% in the information technology, and potentially, moving forward, we're going to really struggle to get those types of returns out of that sector until the ecosystem changes.
Yeah. I think I've heard it referred to as like mean reversion. Like it's sort of, either if it overshoots or undershoots, it'll mean revert.
In statistics, it's called a stochastic walk. It's kind of like what you get if you have a few too many to drink. You're walking in the line, you kind of veer off the path a little bit. But if you draw a point from the pub to the bus stop, that's the mean.
Pretty well get there. Oh, there you go.
So investing is like a drunken walk, I guess.
Well, you might be right about that. That's actually probably a pretty good one. Thanks, Douglas. Bit of a shout out back at you, mate. Thanks for joining us. But mate,
on board.
Yeah. Well, listen, I think we've got one or two questions in here. I think we may have.
I could talk all night, Jace.
Yeah,
so just while you're finding the questions, just so everybody knows, inflation isn't just an Australia thing. It's global at the moment. So we're in the same boat as everybody else.
Let me
what
see.
are your thoughts on NDIS? Oh, this has got nothing to do with NDIS.
No. All right, so tell us about this. Oh, yep, the inflation world.
All right, so this is world inflation, world GDP. So we're literally in a period of time where, and this is quite paradoxical, Jace. It's where things are more expensive, but less is being produced, and we're getting less gross domestic product or less produce as a result of it. Because you would normally think, okay, well, if the whole world industry was a car industry, right? So forget any other sector. The only business in the world was a car business.
Yeah.
Right. Now, you would think, because gross domestic product is basically the produce of a country, right? What it produces. So if the only business was car business, that was the only business in the world, and you have inflation, which means the price of those cars are dramatically increasing over time, in this case, then all other things being equal, you would think that
your GDP
would go up, wouldn't you?
Yeah.
You would naturally think that. And so this is where some sort of rogue economists, or like I like to call them, lateral thinkers, are actually going, this disequilibrium, it can't last that long. One thing has to change, right? One of them has to change direction. We can't necessarily have both of them going in opposite directions. One of them is going to change. And I like that. It's like a 50-50 bet. It's just which one is going to. Now, history would say that likely we'll get inflation under control, depending on how far back you go in history. We'll start to get inflation back under control, which would mean that the two, as you said, would end up mean reverting and would end up coming back to somewhere in and around historical averages, because that ecosystem has had that crown of thorns introduced to the barrier reef. The barrier reef fights back, and all of a sudden the coral flourishes. And we're sort of seeing this everywhere in the markets. I've got bond yields, everything just kind of support the data. But when we started talking about the 10-year bond yields,
there you look at that. Yeah.
And so this is 1 year down here on the right hand side. This is Australian bond yields. Now, we started talking about them around about here, Jace, when we started. Or actually, no, it was actually earlier, January, February, March. So it was around here is when we started focusing on the bond yields and talking about that in Wealth, Wine and Wisdom.
Yeah.
All right. And it was around here where the rest of the market started talking about it, because it hit that 4% mark, and all of a sudden everybody shit themselves and gone, it's at 4%. Well, it's pretty friggin' clear where it was going over the months leading to it. But here's the interesting part. And in statistical analysis, it's called a threshold, or a glass ceiling to a degree, right? It's this point whereby if it breaks through it aggressively, then it will continue to rise, potentially exponentially. But there's these resistance points, and that 4%, as we coined it a little while ago, and it doesn't matter whether you look at the 10-year or the 5-year. They're obviously very, very similar. They're just different time frames that we're looking at here.
Yeah.
They're hitting that resistance point, right? So if we sort of go back to here and we go, well, what does mean reversion look like? Well, at the moment, the inflation seems to be tapping, but likely it'll stabilize, turn around, and we'll be looking at that mean reversion. And so when we look at investing, it's a matter of going, well, what does mean reversion look like?
Yeah.
And when it comes to investing, I always say there's summer, autumn, winter, and spring, and there's different types of things and themes that you like to look at during these periods of time. But until this number up here and interest rates start to get a little bit more consistent and the globe starts to feel more confident with them, that flight to quality and that flight to yield is likely to stay and hang around until these other stuffs balance out. And we were talking about it from in debt terms, property development terms, company terms. People like to lend money into areas or give money into areas where there's a degree of certainty. And more money will flow, the greater level of confidence in that sector.
Yep, totally. Yep. Indeed, mate. Indeed. Well, listen, I think we've only got sort of one question we haven't answered for today. And Tim is talking about NDIS, the National Disability Investment Scheme. And Tim, again,
National Don't Invest Scheme.
Yeah, it's an interesting one. The housing can be very lucrative if you get it right. But again, it's a government scheme, Tim, and like many government schemes, they work really well for a while, and then sometimes they have a bit of a challenge. Depends on a bunch of factors, Tim, and sort of I'll quickly allude to them. Number one, lending. If you are trying to build an NDIS property, lending's actually quite challenging and weird and difficult. A lot of the lenders will want to treat you like a commercial borrower. You'll pay higher interest rates, and the lending is a bit more specialized. Okay, so most likely 80% or less loan to value ratios. Okay, so if you've got a small amount of capital, it's probably not for you. I would say it's absolutely not for you. If you're on a low income and you've got small amount of capital, it's not the type of the deal that you would want to do. Then the next part would be, the scheme in itself is perfectly fine, but you have to go through facilitators and providers to get access to the people who are going to rent it from you. So there's 2 or 3 layers for your income as you actually now build this property. Now you want to get your tenants in. There's 2 or 3 layers to have to create income from that. So it's nothing like, absolutely nothing like, nothing at all like a regular rental. You advertise it, in realestate.com and someone rents it. You have to have relationships and connections and understandings and registrations, and it's quite expensive to pay and put your property up and online and available. It's on average $5,000 to list your property with an NDIS provider. So the upfront cost is significant. On the back end of it, if you can handle the risk in the emotional and the mental and financial upfront risk on it, it's actually very lucrative. I've got a number of investors who have them, but they are super challenging to get up and out. But the third and probably the biggest risk is it is a government-funded initiative, and one day someone wants to unfund it or lower the funding or defund it or whatever, and it has that exposure, you'd say, oh, you'd find it hard for the government to unfund, disability stuff, and you'd be like, well, let's have a look in history,
Well, mate, most of the time they don't unfund it. Can I tell a little story?
Go for it, man.
Now, I've been involved at either product development, tax structuring, promotion, product building of many products, probably, 30, 40 products over my life, which I've helped design from different perspectives. And they were, where I was really good, was figuring out the tax and legal structures around things. Now, whenever the government bring in initiatives, That's when I used to have a field day, right? Because they would bring the government would bring in, and I want to talk to you about something called the 2020 vision. Now, the 2020, where 2022, did they hit the vision? Spoiler alert, no, they failed. It was a government initiative that's pretty much guaranteed to fail when it's a government initiative in Australia. And so the 2020 vision was, and if I lose my way, because I might, my point was going to be that they just slow it down. They don't stop it, they just slow it down. So the 2020 initiative was having certain amounts of forestry planted across Australia by the year 2020. And they had a target. It was about carbon. You know, it was a big buzz way back when. And it started what was the agricultural investment boom, right?
Yep.
Because all of a sudden, I helped create a product that had 150% tax deduction. So literally, you almost put no money in. You could fund your way into it, right, by the tax deduction if you were top marginal. Like, it was a brilliant product. It was quite incredible. And I think I just called it myself incredible. I wasn't incredible. It was the loopholes that were brought by the government creating these initiatives, right? So fast forward 5 years. Several $1 billion, I think it was 5.7 or 7.5. I've mixed it up, of investment into the sector, somewhere around there. And almost the whole sector combust. Literally, like 90% of the sector blew up. And it happened within about a 6 to 12 month period. And what happened was the government brought in the incentives and then just did this. They've gone, oh yeah, oh, it's green, it's great, it's carbon, it's wonderful. It's 2020, yeah, okay. And then next year it was 2020. The year after it was 2020. The year after it was 2020. And what they slowly did is their focus just and then change of government. Oh, it's not our problem. So the reason why I tell this story, because it crippled billions. This is where the government, again, was almost solely responsible. Like, there was some, Collins Street, criminals allegedly that probably contributed to it, or some maybe unethical kind of behaviors. But ultimately, the government created an initiative which probably had great merit to it, then turned its back on it, didn't focus on it, didn't nurture it, didn't grow it, and it just died a natural death by itself. And
well, I mean, here's an example of it right now, Andy. This one. So NRAS, National Rental Affordability Scheme, NDIS. So NRAS is now ending, which is dying a quite slow behind the scenes death. Alison's saying, why is it ending? Well, Andy, they are bringing in another initiative because the government has no idea. That
didn't work. Here's
a new idea, folks. And it's still a disaster because legislation is miles off the pace. So, Alison, NRAS is ending because government want build to rent companies to come into Australia. And that's another thing that's actually absorbing a significant amount, but not as much as everyone would hope. But Andy, in Melbourne, we were looking to help people buy a really nice property in a really nice location, not far from the CBD, about 9 kilometers from the CBD. In came the build a rent company, and they bought the whole thing. They bought it, and it's now, so it will never come to market as a piece of real estate that anyone can own, and it will always carry the stigma of something like community housing or council housing, it doesn't actually help supply the general supply of the market because it's supplying not the market. And that's what happened with NRAS. NRAS choked, Alison, because it actually didn't help in any way, shape or form. And then the government it was actually probably an okay idea. And then they choked on it. They didn't administrate it. It became too hard for developers or investors to actually even sign up to do or help or be involved with. And then they said, oh, this is too hard. We're going to just chuck it in the bin, billions of dollars worth of initiatives down the toilet, you know.
They just
So
don't
that's
care.
what happened.
They don't care. And so here's the thing. I'm not warning anybody off any type of investment. But you and I say, Jace, the biggest risk to investment, in my opinion, is actually, and number one, is actually the government. Legislation and government behavior is the biggest risk to investing, full stop. That's my opinion. That's what we say. And so if you are investing in something...
being proved right by it. Ding dong, the witch is dead. You know what? Why don't I just bring in a land tax that's unconstitutional? Let's have a crack at that.
I love it. I love it. How we don't have guys like Andrew Denton doing satires on, on late night television. I don't understand it. It's insane. But wherever the government is giving initiatives and that makes investments work, you've really got to consider the government side of it. And I'm not saying don't, because you can make a lot of money by going into these schemes, and we have at different points in time. But understand that the government changes its mind pretty frequently, and based on popularity, and what is popular today is rarely popular tomorrow. And so going into things like NDIS as investing, going into agribusiness, and here's the thing, we're in renewables.
Yep.
Right. I'm very big in renewables at the moment, and I'm very big in types of energy sectors. And so I just want to highlight that, because yes, I'm investing there, and that is highly government subsidized. Right. But we are very, very much on top of what the government are doing in that sector. And if they look like they are disinterested, or it looks like it's not popular to be green anymore, we will pull money out of that sector faster than you can blink. Because ultimately that's the stimulus, because we know that then it will drop, and then it will become self-sustainable, which is kind of ironic, and it will go bang. Right?
Yep, exactly.
So, I'm not saying don't, but I'm saying be very, very mindful of when the government assist, because if it's
when they stop assisting, will it? Yeah, when the government stop assisting, will it be alive?
Can it stand on its own two feet?
Yeah, and a lot of people say that about negative gearing, Andy, with real estate, and it's like, well, listen, if negative gearing disappeared tomorrow, I'd be actually pretty happy with that, because my rents would actually go up. Because I'd actually prefer rents to be up rather than having to claim my tax back. Like, I would prefer that. I think that's a smarter way to do it. But the way we've got it is the government subsidizes people's rents through tax deductions to property investors. That's what it is. Negative gearing for individual property investors is a rent subsidy, because the government doesn't know what they're fucking doing. So it's like, it's ludicrous. But Andy, you don't look a gift horse in the mouth, but if something went, if something changed, you go, right, would I be able to sustain that? Yeah, no problem. A couple of years of maybe lower income until it all reverted and leveled out, and I'd be off and running, So those sorts of things. So, but hey, listen, folks, while we've still got a few of you online, but there's something very special going to happen next week for Andy Fenton and his lovely partner Mags, and Andy's going to become a dad. Hey, mate. So raise a glass, folks. Give him a shout out in the chat. Andy Fenton, Dad Fenton, next week. Is it Monday? It's booked
Monday,
in, right? It's Monday.
Yep.
Far out, man. That is so close, buddy. So, but folks, we are going to leave Andy alone for a few weeks, and he's going to settle into being a dad. At this moment in time, we'll probably kick off first week of November. And we're coining it the all new look, all new show for Wealth, Wine and Wisdom. We'll snazz it up a little bit. We got some shout outs here for you, mate. So, Deb,
thank you.
There you go, Alison.
Thank you, team. Thank you so much. I really appreciate it. Like, this is round one for me, mate. And the reason why I'm wearing this shirt is to take away from the grey on the beard.
Mate. You're just getting started.
Mate, I'm on the main straight, and really looking forward to it. And, mate, happy to have people like you and all of you listening in our corner, because I might be reaching out for advice. Can't wait for the dad jokes. Well, Alison, you've been listening to them for the last few years. They really don't get any better than what I've got. But thank you, mate. Appreciate it. And we really do. And thank you all for the shout out. That's lovely. Really looking forward to the journey. But also really looking forward to, a couple. We have a metaphorical child that we're going to bring into the wealth, wine, and wisdom space, and I'm pretty excited to do that as well. So we will be back, stronger, faster, probably not funnier, but
sleep deprived, but okay, but hopefully still there.
So we'll look forward to catching up with everybody on the first of, or whatever the first week of November is. So
we'll let everyone know.
Yep,
indeed.
Well, mate.
All right, mate. Well, let's put a pin in that one then, folks. There you go. Back at it for a short time. Not a long time, but certainly a good time. Thanks for joining us today on Wealth, Wine, and Wisdom. Look forward to seeing you guys again in a 3 to 4 weeks' time. But, mate, thanks for hanging out. Always awesome to hang out with you. I've run out of wine now. I'm actually completely empty, so that's probably good timing. And, folks, it's a good night from me.
And it's a good night from him. Good night, everyone.
Good night.